Ladies and gentlemen, this is your captain speaking. Welcome aboard the Financial Independence Podcast. G'day, and welcome to another episode of Captain Fi, the Financial Independence Podcast, where I open the cockpit to some of the best and brightest in personal finance, as well as those who have reached or are on their way to financial independence. Before we get started, remember, nothing said here is financial advice, and you should always do your own independent research before making any financial choices. With that being said, I hope you enjoy the episode and learn something new. Okay, today I'm chatting to Katherine. How you going?
Good, thanks yourself.
Yeah, I'm not too bad. It's actually quite timely that we're going to have this discussion because I have decked out my apartment with a few nice things. So I've been wondering about contents insurance. So perhaps that's a question I can ask a bit later on. But I just wanted to say thanks very much for making time. Welcome to the show. And I believe you're joining us from Canberra.
Yes, Canberra is where I'm based most of the year. If you're a Canberra local, 4 seasons is what you sign up for. 4 very distinct seasons. It's crazy dry hot in the summer and it's freezing cold with winter. Personally, I would love it if it snowed. It would make it feel a bit more worthwhile. It has its swings and roundabouts, so I love it.
I always love flying into Canberra. It can be a bit of a challenging approach with heavy weights, and especially when it's hot just because of the terrain. But yeah, absolutely beautiful scenery. So I've spent quite a bit of time in Canberra, and I'm a big fan of running and cycling around Burley Griffin and doing the runs up Black Mountain. Yeah, it's a beautiful area.
It's a very livable city.
Are you always been a Canberran local, or did you choose to move there?
Oh, no, I came from a sort of really tiny town in New South Wales, and my parents moved here, sold the farm, came here. They just felt that it was time to come to a bigger city, so Canberra was the place that they went to. And also it was a choice because it meant that we would either have to go to boarding school as kids or come to Canberra, and then they wouldn't have to send us to boarding school. So that was a pretty simple choice for my parents. And then I've lived in Canberra most of my life. I've lived overseas twice, but Canberra has always been home.
Oh, wow. So always, yeah, I feel you on that one because I've moved around a bit for work as well. And coming back home, it's just been wonderful. In fact, I went to a bakery that I haven't been to in 7 years, and the ladies behind the counter recognized me. No, it wasn't immediately. They said, "Oh, you're a little bolder than when we recognized you last," and sporting a few more wrinkles. And I said, "Oh, thanks very much. Give me my banh mi roll and I'll leave." But it was nice to be back in the old neighbourhood, so I can see why you're always wanting to come home. So where did you live, out of interest? Where did you go?
As where I moved overseas. Yeah. So I sucked at language in high school, but I was determined to learn French. In terms of a value decision, I really wanted to learn French language, and I worked out I could spend thousands and take forever and a day to learn French by going to Alliance Francais classes, all the kind of stuff. And I thought, what better way to learn it than just to dump myself in the actual country and pick it up through intensive language lessons, immersion, and the rest. And that way I get a holiday to boot. I decided I want to go live in France. I found a place that they taught French to you, and because it's for international students, they didn't teach you in English, they taught you in French. So you learn really quickly. And so I spent 6 months over there, 20 hours a week worth of classes, and within about 3 months, you're pretty fluent. And then I used that as a base to travel around France and other parts of Europe. And living as a student, it was highly affordable. It's ruined me forever because now when I hit FI, that's what I want to do. I will go to another country, except I'll probably spend 12 months there, and I will pick up the language. I'll live as a student, so it's all on student rates, long-term accommodation, pick up the language, the culture, know the ins and outs, and come back to Australia for a bit, and then go rinse and repeat and pick up another language and culture for another 12 months somewhere else.
Wow, that sounds like a wonderful goal. Also, holy moly, just moving to another country to learn the language. Talk about straight into the fire, so to speak. Must have been really confronting.
It makes a lot more sense now. Something, you and I have talked about off air, but, I'm ADHD. Looking back on it, once you get diagnosed, you go, oh, that makes so much sense. Because that's impulse control. I want to live overseas. I'm going to go do it. And I just did it. So
that's awesome. Yeah, you're a bit of a go-getter, Katherine. You're just more of a doer, not a talker.
Yeah, pretty much. And then the other time I moved overseas, I actually worked as a croupier in a casino. And the only reason I selected that job is I wanted to live and work overseas, and I knew that working in the casinos on the cruise ship was a great way to be paid to travel. So I did a 6-month contract working in the Caribbean on cruise ships as a croupier. So
Wow.
yeah.
So you basically have free holidays. That's very efficient.
Oh, yeah, I don't think I could ever do the work on the cruise ship again. They work you to the bone it wouldn't even be a legal minimum wage here in Australia.
Wow.
But I am very glad that I did it, but I would never do it again.
So hang on. So tell me the secret. Is it true the house always wins? How do you game the system?
There's only one way, and it's totally illegal. And that's cheating.
Oh,
So.
cheating. No, yeah. No aces up the sleeves, hey?
Yeah, but the house always wins. I've seen a lot of stories from working in the casino, some famous people getting kicked out through to just, poor behaviour by people. But most people, if you talk to them about the casino, the first thing they'll tell you is, oh, yeah, I've played a couple of times, but I've always come out up front. Maybe you have, maybe you haven't, that's fine. But those buildings don't get all those wages paid and the rent paid and the lights paid from people coming in and walking away with the win.
Yeah, exactly. Look, everyone has their big fish casino story. My best ever casino story was I went in, I think I spent $100 playing minimum bets on the roulette wheel. But how good's this? I left the casino super drunk. I was drinking mojitos. I don't know whether I won a lot of games, I lost a lot of games, but either way, they kept giving me mojitos, and I reckon I drank more than $100 worth of mojitos. So I'm going to call that a win.
Oh, I've seen some good stuff. One of my favourite experiences, there was a bunch of guys, and I think they're out on a bucks night, and they'd lost a lot of money, and they were down to their last $100, and they went, stuff it, we're going to throw it on a roulette table, one I was dealing at, and we'll just go hardcore. And I can't remember what number they threw it on, but they threw it on a single number. So if they get it, the odds are 35-1. On the wheel up, and lo and behold, they're literally half the way out the casino, and it lands on their number. So their $100 suddenly became $3,500 plus the original 100. So they were walking away with nothing and suddenly walked out with $3,500.
I wonder for people on their way to fire, like I wonder how many people would go, okay, I've got $100,000 in index funds.
Yeah.
Throw it all on black. Either I'm going to reach fire tomorrow or start again. Jeez, I'm getting anxiety just thinking about that.
Yeah, same. Working in a casino has actually ruined the enjoyment for me because I've seen so many people lose money. And if you've worked hard for your money, and then I think it's hard to risk it in a very quick moment like that.
It's funny because we're seeing so many people doing basically just that, but on things like cryptocurrencies and, there's record number of people gambling on essentially IPOs and in retail investors joining the investing market, but not really knowing what they're doing. To me, it doesn't sound too dissimilar from just throwing it all on red.
Oh, absolutely. And there's superstition, there's beliefs, there's the she'll be right attitude. There are risk and reward are two very different things. And it really does mess around with our psychology. So, yeah, so I stay clear.
So, look, I can't think of anyone better to be on the show to talk about risk and insurance. Now, that's your specialty, right?
Yeah.
So, Katherine, what is risk? How do we quantify it? And for those on the path to financial independence, like, why should we care?
Okay, so I'm literally going to jump out straight with a dictionary style definition because, what risk is, it's just a situation that involves exposure to danger. And in the context of insurance, it's an act, taking out insurance, it's an act of managing your exposure to that danger, the harm, the loss. And that could be the loss of an object, like a vehicle or your contents, or the personal exposure that could be like litigation. It also could be loss of future earnings. Some of it you can quantify. It's really easy. If my house burnt down, what would it cost to replace it? That's really easy to go, what's the liability if that happened? Things like what happens if I can never work again and I'm faced with medical bills, that could be a little bit harder. And that's why people like me have a job to help people work that out. And then you've got things like there are risks that you could absorb if they did happen, but it becomes a choice. Would I want to or would I not want to? So it really depends on the asset or the item that's at risk at the end of the day.
Okay, so trying to manage unknowns or provide a bit more certainty where there is uncertainty.
Yeah, absolutely. And the whole reason that you might actually want to consider insurance is because at the end of the day, if you were to lose the asset and that's unacceptable to you, that's why you consider insurance. At the end of the day is just transferring the risk for you to somebody else. You're actually asking somebody else to take on the risk, and you pay them a premium for that. If it doesn't happen, they get the money, but if it does, they've got all the risk. So insurance is literally nothing more than transference of risk.
So why would somebody take on your risk then?
It's the concept of pooling risk. So, for example, if you were to come to me and say, hey, Katherine, if I could never, ever work again, do you promise to pay me my wage until age 65? I'd be like, no. If I had actuarial data behind that, and then there was 10,000 people that came to me with that same problem, and I had systems in place to assess that and worked out the law of averages, I could probably make money out of that. It's like a lotto. I don't know if people think of the lotto as in terms of being a benefit, but at the end of the day, everybody contributes and there's a winner somewhere. So everybody likes to know that there's a possibility that if it was needed when it comes to insurance, unlike the lotto, there's no certainty. But with insurance, if this does happen to you, you will get a payout. So you've got that guarantee there. So I think that's really important because there are literally some risks that you cannot afford to take on yourself. A great example is, let's think about cars. If you drive and this is one of my favorites because I see this on forums all the time. I see parents going, I've got a 17-year-old, they're driving a $3,000 bomb, and who's the best person to go and get comprehensive car insurance? My first go-to is thinking, why would you bother? Because the insurance that a P-plater driver will pay, or a learner driver, is probably worth more than the car that they're actually driving. So the risk, if you just have the money, 1 year's worth of premium, maybe 2 years worth of premium set aside in a bank account, you can manage that risk, you can retain it. And as long as you don't crash that car in a year or two, then you're ahead. Whereas if that person who's driving, say, $60,000 car and they've taken out a loan for that, if they lost that car because they hit a kangaroo, got stolen, that would be a huge detriment. So really for me, I look at people like that and I go, if you've got a really cheap car, why would you bother with comprehensive car insurance? But it would still make sense to say, have third-party insurance because who knows what you're going to hit. You could lose control and plow into the corner of a building. I know someone who's done that. And we're talking like $800,000 worth of damages. Or someone who hits a Mercedes or something like that. That risk is harder to quantify. Third-party insurance is pretty cheap. So that's an easy risk to cover off on. But yeah, I still find it amazing the amount of parents are like, yeah, my kid has a cheap car and I need comprehensive cover. I'm like, I don't get it. The risk-reward ratio is not there.
Exactly. Look, so that's exactly the conclusion I came to with my personal car. I drive a car. It's pretty old. To me, it's wonderful. I still love it. I take really good care of it. In fact, my headlight broke the other day and I was in the car park at Repco replacing the light bulb. I just love it and I can keep it running. But yeah, I looked at getting comprehensive insurance for it and they wanted half the car's value every year or something. And I was like, no. And I ended up getting a third party because I really didn't want to rear end a Porsche because where I live in Adelaide, there seems to be a lot of sports cars and Maseratis around the joint. I don't want to ding one in the car park. So I just paid $200 a year for the third party. And for me, that seemed to be quite a reasonable compromise. And
yeah, because you've capped a potential unknown and unlimited almost risk in a sense.
Yeah, and I joked about it at the start when we started talking, is that no, I don't have home and contents insurance because you
rent, so you don't need home insurance. But
yeah, exactly. Actually, no, that's a really good point. I am going to need home insurance for this investment property. It's currently being built. But yeah, I don't have contents insurance because all of my things cost less than $10,000. And I tried to have I had this weird tick where I was like, I need my possessions to be less than 1% of my net worth. And so I'd have all secondhand stuff. But now I've moved into a bigger apartment. I'm trying to have a bit more of a lifestyle and I bought a big TV and I don't know, it feels very un-fi, but anyway, I'm doing it. And now I'm like, oh, gee, maybe do I need to get contents insurance? So that's kind of like the next thing that I'm going to be looking at. And maybe I can pick your brain as to whether you think it's worth it or not. But similar with the car, I thought, look, I can just buy another car if I crash mine out of the dividend stream, the business income, or my emergency fund. So I thought, yeah, there's not really a huge need there. And my philosophy has been to only insure against things that were going to devastate me financially.
Yeah, things that you can't financially recover from, they're the things that are important to insure for.
Yeah, and I guess I have to point out as well, for me, I'm a 30-year-old single guy, I have fairly good health, I don't have any dependents. And it was actually only recently speaking to yourself, I realized how important it is. And so, I wanted to try and focus a little bit more because I think especially parents with young families or potentially they're looking after their parents and they've got a lot of dependents. I think maybe it's something really that needs to be looked at.
At the very least, people need to consider it. One of the things that really breaks my heart is when something, because I do pro bono work as well, and what really breaks my heart is when someone comes to me and goes, I didn't even know that this was an option. I did not know we could get insurance for this. Why didn't someone tell me? And I don't want to be the person that was there who didn't tell them. So I'm a really big believer in educating people and explaining, look, these are your options. What's important to you to cover? And if you were to cover, this is what it would cost. Then people can decide on that trade-off risk-reward conversation themselves. And they're going, you know what? If this happens and I've decided to only partly cover this risk, or I've decided not to cover it at all, then at least they can kick themselves and go, I did the wrong thing. But at least it's not a case of the going, if only I had known. If you've known and you've made a decision, at least you've made an educated choice. But I think people should always be given the opportunity to make the choice for themselves.
Yeah, I've heard someone say somewhere, they're like, oh, insurance is the only thing you don't need until you do.
Yeah, it's like an umbrella. Who would want to take, I guess it depends on where you live, but in Canberra, it doesn't rain very much. And it's just one of those things, like an umbrella is something I might pull out once a year. Like it barely rains, or at least never when it's inconvenient. So it's one of those things that carrying it around every day is a huge pain in the ass. But if it was a torrential rain and I've got to get somewhere outside and someone was selling a stand of umbrellas, I'd be like, I don't care what that costs. Give it to me. I would really want it. And that's obviously, a bit of a very simple analogy, but it only becomes valuable when the need is there. And at that point, especially when it comes to insurance, at that point, it's too late. You have to be ready before the unexpected happens.
So what kind of insurance are there? I think everyone understands car insurance and home and contents. Like I think most people probably understand that. What other kinds of insurance?
Oh, there are a zillion insurances out there. You've also got your things like your medical insurances. You've got your professional legal insurances, that sort of stuff. What I specialize in is the personal insurances. So that broadly falls into 4 key areas. You've got your life insurance, which is pretty straightforward. If you die or you're terminally ill, it gives you a payout. TPD, which most people have that in conjunction with life and their super, and that stands for total and permanent disablement. That's the insurance that it's only going to pay out if you will never ever work. Then the 2 other insurances are income protection, which most people are familiar with. That's security of cash flow. And then the last one, which is the insurance that people have the least of, but it's actually my favorite, and that's trauma insurance, which also gets called critical illness and cover. And that's got nothing to do with your ability to work. It actually pays out if you get diagnosed with an event. So, for example, cancer, heart attack, stroke. They don't care if you're working or not. If you get diagnosed, you get a lump sum payment to use as you see fit.
Okay. So that sounds like there's a big bag there. All right, let's break it down. Let's start with one. Okay, so say I was a client and I was coming to you and I'm like, hey, Katherine, I've got third-party insurance on my car. I don't have any contents insurance in my home. Yeah. What other insurances do I need?
Legally, first thing I'd have to tell you is I can't talk to you about those. I'm only licensed to talk to you about a specific category. So, you can have general conversations about, what do you have in place? But if I was face-to-face with a client, I can actually only really talk about the personal insurance stuff. Yeah. If they've got private health insurance or not, I can actually walk them, say, okay, because you don't have this, I'm guessing you're paying the Medicare levy surcharge, for example. And if I realise that there's a need for that, then I'll typically refer people on to other places where they can get help with that. But in terms of that private health insurance, I do have a few opinions on that side of things. It does get to a point, and a lot of people think that private health insurance is there to save them money. I actually think that's like the biggest lie told ever, because the biggest thing that will ever save you money is just going through our public system. It's really inexpensive, but it does limit you to the options that are only available in our public system, and you may want options outside of that. It also means that you have to wait on the leisure of the public system. Private hospital cover is really about 2 things. It's about not having to pay the Medicare levy surcharge, which will be paid if you're earning more than a certain amount. And the other aspect, it gets you access to treatments. Once you have private hospital insurance, the only way it saves you money is, of course, if you've got a base level cover, you have huge out-of-pocket costs. If you've got the top level cover, then obviously you can have much lower out-of-pocket costs. But it's compared to the public system, it will still be more expensive than going public. Yeah.
So Medicare is generally pretty good for everyone, but for some people who want more convenience or luxury, that's with private health.
Yeah. And I have private hospital cover myself, one, because I don't want to pay the Medicare levy surcharge, but also because if I'm in pain and I need surgery, I don't want someone to tell me to wait 12 months or 24 months. I want treatment fast. So for me, it's about my comfort levels more than anything else. I think people need to be they really need to understand what is it and what does it cover them for. I think that's a really important thing.
Yeah. So my family, we did grow up below the poverty line. So private health was never an option for us. And yeah, we have had some pretty serious medical emergencies and illnesses in the family. And we've gone through the public system, Medicare, and I've been super, super happy with the level of care that everyone's had. For my job, I actually had private health through my work. And I had a couple of procedures, like when my wisdom teeth out, and I know rhinoplasty, because I was getting nosebleeds from boxing. And that was done through the private system, which was really quick, I guess, much quicker than what the rest of my family had through Medicare. Yeah, interesting. Okay, so it's something people are going to have to like weigh up the pros and cons.
Yeah, and something that I find interesting too is sometimes I come across people who, let's say, they're in their early 30s and they start going, oh, if I don't take this out, when I do take out the private hospital cover, I'm going to get that 2% lifetime health floating. So they may decide, they think, you know what, I don't have to worry about it. But one thing that I do like to remind people is if you're in your early 30s or mid 30s and you think, I don't need it right now because I'm not getting hit with Medicare levy surcharge, you're also betting that your income's never going to go up. If you're hoping, I would think most people want to earn more as they get skilled up and time goes on. It'll probably get to a point where at some point in your future, you are going to be in the territory where you're earning enough that you are having to be forced to pay Medicare levy surcharge. And let's say you delay that decision until you're 50. Then you're going to have a 40% Medicare levy surcharge that you'll have to pay for 10 years to get rid of that. So if you think you're going to need it in the future because your pay will force you to, you've always got that consideration of, do I take it now before I technically have to take it out to avoid that hit down the track? So that's something that people need to think about too.
Wow. Yeah, I didn't realize it was that much. So you've almost paying double.
Yeah, well, it's 2% per year that you delay taking it out. So if you take it out when you're 50, you basically delayed taking it out 20 years. So 20 years times 2%, 40% loading.
Yeah, holy moly.
Yeah, and you pay the loading for 10 years before it disappears.
Would going to an insurance broker or an accountant, how would people figure out, or do they just have to do the maths themselves at home?
I think there's a lot of online tools which will help people, and there are so many comparison websites. But if someone was to be looking at private health insurance, I think the best way to go is to go to the government website. You've got those whole isolate, compare the markets. They don't actually compare the market.
Oh, yeah, it's just an affiliate
despite their names. Oh, yeah. And they'll put at the top of the list whoever pays them the most. But if you go to the privatehealth.gov.au, so obviously that .gov address gives you a good indication. And the great thing about those sites is they actually compare closed funds. So if you have the ability to get access to defence health, for example, things that not necessarily everyone can access, they'll also include those in the comparison. So I'm fortunate that I do have access to a closed fund that you have to have worked for a certain entity or been related to someone who does. So I've got access to a program like a health fund that most people can't, and they have a rate of 97% profits returned to members. So I love my health fund. They're really good. But those kind of sites really help you make accurate comparisons without a bias from the person who's facilitating it.
Yeah, of course. That independent stuff is super important. Okay, cool. I will make sure to include a link to that in the show notes so anyone who's listening can jump onto the blog and can go and compare their options. It sounds like some of those closed funds might be the way to go as well. If they're like not for profit, that's generally a good idea, right?
Yeah, the mutual funds and the like. Yep.
Yeah. Okay, so that's health insurance. Okay, briefly, I'll just say my experience about car insurance, and this could be wrong, so please correct me.
Yep.
What I have personally chosen to do, I've just got third-party insurance on my car. My car's worth less than $5,000. I cranked my premium, excess. I put that up as high as I could go to get my premiums down. And I also ticked off all the extras like roadside assist. I don't need any of that. Oh, funny story about that. I stopped my roadside assist and then I ran out of petrol in a regional New South Wales town.
I did the same thing and then had a flat battery.
I couldn't believe it. Holy crap. I'm literally international transport pilot. I fly around the world. Fuel management is my job. And I literally ran my car out of fuel. It was because it was like $2.20 at a pump. And I was like, I refuse to pay that. I'm going to go to the next town where it's $1.50. And
Yeah.
Anyway, so that was a perfect comeuppance.
But that's a risk you can control. Lesson learned for next time.
But so in general, that's what I do with my car insurance. Crank the excess up, try and get the premiums lower, try and give them as much detail as possible. I call them every year and haggle, and I pretend I'm going to switch and I'm going to this other place has underquoted you, and maybe I'm a little creative when I tell them what the quotes were, and I usually try and get them to knock it down. So those are my tips for getting cheap car insurance. I don't know, Catherine, am I on the right track here? Should people be doing that or?
Yeah, I like what you've done, that you've actually considered whether you even needed the comprehensive car insurance. Yeah, that's awesome. I stumbled upon that strategy, I think, because I drove a motorbike at one stage, and having my L's on a motorbike, I think my bike was worth about $4,000 and the premiums were like $2,500 for comprehensive. And I'm like, that's stupid. I could just ride off the bike and within a year I get another one, same price. And but I didn't think I was going to ride off my bike, and I didn't. So I just saw that as a waste of money. So I just stuck to the whole third-party comprehensive. So because at the end of the day, if I lost that asset, it would be inconvenient, but financially devastating. Not
interesting. I had the same with my bike. I just had third-party on it. I used to love riding. And I figured, Super Sport 600, if I crash this thing, I was like, I probably am not going to want to ride anymore.
And if you crash it, probably the biggest risk is what's happened to you, not the bike.
Yeah, public service announcement, make sure it's always registered, because when you register your car, you pay third-party
life insurance.
Yeah, life insurance, that's right. And that's what is separate from the property stuff. So
it protects the people you hurt.
Yeah. So, don't ever drive an unregistered vehicle.
Another tip from a case I came across, there was somebody who was driving an unregistered car, and he was actually hit by a motorcycle who made an illegal move on the road. But because the car was unregistered, technically he wasn't supposed to be on the road, so therefore he was at fault. So he got the small claims court liability, which was significant.
Wow.
So register your vehicles. Don't drive unregistered.
Absolutely. And look, I'm just going to go out here and have a little public confession, all right? I had my registration paid in like monthly installments, And there was
so expensive.
there was some kind of muck up, right? So previously, you can choose to pay your rego like
monthly, quarterly, 6 monthly, annually.
Yeah. And so I used to do it annually, but then it was annoying trying to manage my cash flows. I thought, you know what? Let's break it down into monthly, just make it a bit easier to manage my budget. Anyway, something happened and I just didn't check, and the payment hadn't gone through to Motor Reg, and I drove an unregistered car. And I went through a camera, just a normal red light camera. It wasn't a red light, or I wasn't speeding or anything, but anyway, it just scans your number plate, and I copped a fine, and it was in the thousands, it was 2,000 or something. And I was horrified, and I was so ashamed of myself. And I couldn't believe, if I had been in an accident, I was completely unprotected from that liability, from that medical aspect. I now manage my registrations annually, and I have a note in my diary, and I have an alarm on my calendar, and I have a paper copy of it as well. I'm never, ever going to forget to pay it ever again. So I just wanted to fix my budget. I just increased my emergency fund, or my sinking fund, a little bit higher. And then that way, when it comes around to pay the rego, boom, pay it, and done. So learn from my mistake, guys. Don't ever do that.
Yeah.
Okay, so that's car. Okay, contents insurance. So what is contents insurance, and is it even worth bothering with?
Once again, it comes down to what you have and whether it's an inconvenient or not for you. And I think it also depends on the area that you live into. I have never, ever experienced a break-in. But at one stage, I did live in a suburb where the street that I did live in, there was constant break-ins. And so the loss of property was a very real prospect. And if you can't handle that loss of property, then you insure it, and that's what you choose to pay. So I think the best thing is to do, you go get a quote, you work it out, what is the risk, what would it cost to replace this? And if you go, it's an unacceptable risk to me if this happens, then you take out insurance. If you look at that and go, I cannot bear the risk of this. So you take out insurance, but if you're prepared to absorb it, you've got the capital to replace it. I think there's some things in your house, the things that are nice to have, some are need to have. So you manage it accordingly. I am a really big fan of Facebook Marketplace for furnishing a house. I have been really patient and scored some massive bargains over the years, and it does wonders for any budget. But I've learned that you can pretty much deck out a home pretty decently for about $10,000 if you're prepared to do second hand, and it may mean that your furniture may not match from room to room, but if you're patient, you can manage. You'll find pieces over the time. So yeah, I actually tried to reduce my contents insurance with my insurance at my last renewal. I'm actually due for another one. And they actually wouldn't let me reduce it any further. They're like, no, we don't believe you could actually reduce this any further. So I'm like, fine, whatever. I'll just suck it up and pay it. So I did, because I have a house. I've got a 4-bedroom house, and it's full of an entire house worth of stuff. Tech devices, kids' bedroom furniture, the whole kit and caboodle. For me, that one is probably more about convenience. I lead a pretty time-poor lifestyle, so I don't want the time of having to source an entire household worth of furniture. I would want the convenience of a check being paid out, and then I would just probably even pay someone to refurnish my house, because I wouldn't have the time. So yeah, so money is one thing, time is another.
Okay, so it's almost a similar discussion before versus the Medicare and the private health insurance. It becomes more of a convenience and a time aspect, and you're paying to get a bit of your time back. Look, I love that you're into Marketplace and Gumtree as well. When I moved to Sydney, it was only a 1-bedroom apartment, but I furnished under $1,000, and a lot of my stuff I actually got for free. How's this for a story? Got a coffee table from the side of the road and like cleaned it up and everything. And before I left Sydney, I sold it for $200.
Yeah.
And I was just like, oh yeah. So yeah, pretty much I do the same thing, and I've got a lot of my stuff secondhand here. So I don't know, Katherine, I would say my total physical possessions, including my car and everything, I think it would be under $20,000. I would say in the apartment itself would be maybe 10 to 15. What would contents insurance cost on something like that?
It really does vary, but I'm trying to think back when I had a contents only policy without the house. It probably would have been the last time I owned an investment property. And I remember the advice being that contents needed to cover things like the carpet, the curtains, some appliances, and obviously any other contents that you had in there, which was minimal. And I think the premium I paid for something like that investment property was, we're talking maybe $200 a year. So that was on an investment property. And on top of that, it was a tax deductible because it was an investment property. So it was like no brainer. So I just did it. But because I've now, the biggest risk as far as insurance side is more if my house burnt down, because the house is way more valuable than the contents aspect. So I believe that's probably the part that adds the most to my premiums.
Okay. So if you don't mind me asking, how much is the combined now with the house?
As in the premiums? So,
So like each
my
year.
last renewal, I think I was paying somewhere in the vicinity of about $800 a year. And big tip, if you're looking at, a lot of people think, I need to insure my house for whatever I paid for it. You can't insure land. If your house burns down to the ground, you might need to spend 20 to 40 grand on demolition and removal, but the land is still there. It's only the house you need to insure, and the costs of associated with clearing rubble and whatnot. So that's something that people should take into account. But some people, I've seen people made a mistake. I bought it for $900,000. I need home insurance of $900,000. I'm like, no, it doesn't work like that, because you still own the land at the end of the day.
So if people are trying to get a really good deal for home and contents insurance, is there a place where people can go?
A lot of the insurers will actually have their own things which say how many bedrooms, what year was it built, is it double brick, is it brick veneer, is it concrete tiles, is it terracotta tiles, is it a colour bond roof? I'll give you an estimate what they think it would cost. But for me, one of the things I go off my rates notice. I look at what is my house worth on the market, and I deduct the land value from my rates notice, and then I'll add a buffer of 10% and some demolition costs. I'm like, that's what my house is worth.
Yeah. Okay. All right. So a bit of napkin math, so you can figure it out in an afternoon.
Yeah, exactly. And what happens if the building costs are excessive at that point in time? Well, I'm like, that's great. Then I'll have the money to demolish the house if it burns down, and I will still own the land, and I will sell the land at auction to a developer or somebody else that's interested. And between what I insured the house for and the rubble costs, and I get the payout for land, I can go buy somewhere that was equivalent to what I owned.
Okay. We're one way to rest easy at night. Okay. All right. Great. Okay. So I'm trying to think through the list of what we talked about before. So then there was the health insurance. We talked about the government.
And then there's the personal insurance and that sort of stuff. Yeah, that's my jam. That's like my 9 till 5.
Okay, awesome. So we've been leading up to this part. So this is the good bit. Okay, so there was income protection insurance, life insurance,
TPD,
really should be called death insurance, shouldn't it? Like,
It is in some circles. What's
Yeah.
really confusing is life insurance refers to all of the personal insurances. It's also a
Okay.
specific type of insurance as well. So it's a life insurance industry, life insurance market, but it's also a type of insurance in its own. So just to make things confusing.
Okay, awesome. All right, where should we start on this one?
Gosh, there is so much to this, but I think at the end of the day, most people can understand life insurance, right? It's pretty straightforward because it's so black and white when you get paid. You're either dying or you're not, right? Most people will have it inside their super. And what I would say is probably the biggest mistake people make when it comes to sorting out the life insurance specifically is one, they do nothing and they go, yeah, whatever I got in super is enough. Or two, they make the mistake, if they've got dependents, of thinking, as long as my spouse is mortgage free or has a home to live in, they'll be fine, which they're not. They're usually not fine. A perfect example is, let's say you're the average employee male, employee female, or whatever gendered couple combination you want to go for, but you're working to earn an income because you have to. Most people don't spend 100% of their wage on mortgage repayments. So if you're looking at someone and they've got, it depends on where you live, what a normal mortgage is, but let's say someone's earning $3,000 a fortnight and the mortgage repayments are $1,500 a fortnight. If you get rid of that mortgage and you think that's all I need to help my spouse is, yeah, it'll help. Like, you get rid of the mortgage, those fortnightly mortgage repayments, they stop. If you're earning more than what you're putting on your mortgage, your family still has to deal with the income that's just disappeared. And it's pretty rare that what somebody brings in, they're using entirely on themselves. It's usually going to supporting things more than themselves, like spouse, kids, that kind of stuff. And it's that age-old thing, right? Two people can live as cheaply as one. Just because some person doesn't mean the rates halve, the electricity won't halve, the water usage it's not going to halve. If you go on holidays and you're a single person, you got single supplements. It sucks. So life doesn't get that much cheaper for being single. So a really big consideration is going, okay, if I die, yes, you could pay off the mortgage to make sure to take care of spouse, but it goes way beyond that. And that's a lot of the things I take people through. I say, okay, what about funeral expenses? If you're terminally ill, do you want to sit around and do things as you always have, or do you want to go out and live life up a bit and make some memories? And what's it going to cost to do that? If you've got things like people are depending on your income, well, how long do we need to replace it? And how long should we replace it for? I know a really big thing is I work with a lot of parents too. And usually when I say, oh, you're dead, I actually know an advisor who literally puts a sheet over them, like a white sheet. I think that's a bit extreme. But you go, this person's not here. It's now you. It's your kids. After any initial time off work, are you happy to go back to being a full-time? Are you happy to work full-time knowing that it's just you and the kids now? And most people are like, no. And some people go, I love my job. I just need to pay for extra childcare because now we've lost that extra parent in the household. And other people will say, you know what, I want to be with my kids full time until they start primary school. And then after that, I'll only work school hours. Life insurance is about giving you choices. It's giving you dignity, because what's really hard is when someone passes away, I swear you spend 3 to 4 months just on admin. And people throw themselves up because when you die, you don't get out of tax returns. You don't get out of legal responsibilities. There's just more of them, except it's somebody else's problem. So it's really good to have a will. And life insurance takes the financial pressure off and it just gives people time to grieve after they've dealt with all the bull crap that they have to deal with on an admin and legal aspect.
Holy moly. I'd never considered that, if your spouse died, you would be still having to submit their tax return.
Yeah, so you have a date of death tax return, and then so that kind of covers the beginning of the financial year up to the date that they died. And then there's an estate tax return, which is a tax return for whatever they've owned that's without them, and that up until the point where you actually finalise the estate. And then that typically means accounting advice, legal advice, so you can see the professional advice bills start flowing in.
No, it's definitely not as simple as with a car. You just get third party. There's so many unforeseen hidden costs.
Expensive and time consuming. Yeah. I learned that pretty early because I actually worked for a financial advisor and he was the executor of, I think it was his uncle's estate. And as a paraplanner, so that's someone who works on strategies for advice, he was like, this is your problem. So I basically had to administer his uncle's estate. And as a full-time job, it took me about 3 months to sort through everything, like open road magazines from NRMA, and the stress it can cause a family seeing something like that come in the mail, junk mail addressed to an individual, and then telling them stop sending this, and you have to get certified death certificates and sending to membership organisations and all these other places to stop them sending stuff. Yeah. So
you definitely don't want to be having to be working and doing that at home.
And if you're grieving too, so someone I wasn't even emotionally attached to, if you're having to deal with that and it's your spouse or your child or your parent, that's hard.
Wow. So how do you figure out how much life or death insurance is enough?
Yeah, that's why I have a job. I have a process that I take people through, and you have to be able to quantify the risk. Working out, do I want to be mortgage? I want my family to be mortgage free. That's easy. It's one of those scenarios where it's you don't know what you don't know, and I really hate the super fund websites which calculate this for you because they don't get it. They don't understand the real world implication of what happens after someone dies, and they're not looking at these situations clearly. They don't take into account people's choices, things like that. So I think I would say suggest listen to some of the stuff I just mentioned there as ideas, because the biggest thing I get from after I talk to people, like, I hadn't even thought about this. I hadn't considered that element, because unless you've actually been with someone who's been through a terminal diagnosis or helped a family and seen the consequences, not only in the immediate time, but the years afterwards and the regrets that they have, then you start to realize what choices that they would have wanted for their dignity. And the hardest thing for me is seeing a parent who might have been part-time, and then after their spouse, the kids have lost one parent to death, and then they lose the other parent to work because that person goes, I can't afford not to now go full-time. So the kids have almost lost two parents in a way. That hurts. And the guilt that the parent goes through and their struggles is, it's not a nice thing to see someone go through, especially when it's avoidable. And life insurance is so cheap. It's so cheap. It's such an easy problem to fix. Yeah.
Okay, so it's definitely worth seeing a professional to actually work through
help
this
you
together.
work through your choices. And like I said, I'm really big on education, because if someone comes back and says, you know what, for that price, it's worth it, we can do it, great. Exactly what outcomes you've got available to you if something happens. But if you turn around and go, you know what, I'm okay, I really want about 80% of these outcomes and that will get me a lower premium, then great. And if something happens, you go, you know what, it would have been nice to have those things, but I'm okay that I didn't have those things because I made that choice. Like I said, it's that thing of going, I wish I had known. And the only way to do it is before it happens, not after.
Yeah. So in the FIRE community, obviously a lot of people are trying to build passive income that doesn't necessarily require working either full or part-time. Some people do go the Bristol FIRE route and, supplement their cost of living with part-time work. For those people who maybe they have got a paid off house, or they have got shares, debentures, various other income producing investments, does that influence how much life or death insurance they need?
Yeah, 100% it does. 100%. Because once again, like I said, risk is transferring a loss that you aren't prepared to take on you. So perfect example is income protection. Most people go to work because they want the money. Even if they love their job, they still need the paycheck. And the aim is eventually we all want to get to financial independence. And for most people, that doesn't actually happen until they hit retirement. And even then, some people struggle. I'm one of those people, I have no intention of waiting until 65 to retire. My goal is to retire in 10 years, or at least having the option to. At that point, work is optional. And I've read heaps of studies that say that, and I'm pretty passionate about, so I'm probably going to work more than 10 years, but I won't be doing it because of money. I'll be doing it because it brings me purpose and value. But up until that point, I need my paycheck. If it stopped tomorrow, I would have problems. Like, I wouldn't have what I want out of life financially. So for me, I have income protection in place. And I also love income protection because what people think of is they think a couple of things. I don't need it because I've got cover in my super. Word to the wise, cover through super for income protection particularly, it's full of legal loopholes. It's really dangerous. And for most people, it stops after about a period of 2 years. And unless you're going to hit FI in 2 years, then you probably need some sort of cash flow coming in after that point. Now, once you hit fully passive income and your income meets more than your expenses, you actually don't need income protection because your income is not dependent upon your ability to work. But while it is dependent upon your ability to work, it's an asset worth protecting. For an example, and I'm just going to use rounded numbers. Let's say you're 30 years old and you're earning $80,000 a year. So that means if you've got 30 more years in the workforce, that's what, 2.4 million that you're going to earn before you hit age 60. And that's before inflation, CPI, your pay rises from upskilling and all that kind of stuff. So most people, the biggest asset they own when they're young is their ability to pull in money.
Capital,
Yeah. So you are your biggest asset, because most people, if you ask them what's your most valuable asset, they'll go, oh, it's my house. And it's usually got a mortgage attached to it, so there's limited equity. Or maybe they say my super. But usually it's what they're going to earn between now and retirement because their own business. They are their ability to bring in money. That's a huge asset. If you have a business that pulls in passive income, that's valuable, right?
Yes.
You are the same. You are the golden goose. Now, for example, most people will insure a car or a house. These things don't make money. You don't want to see them lost. But whenever you pay those premiums, unless it's an investment property, your car, your home and contents, you don't get a tax deduction for that. Income protection, it protects by far your most valuable asset, and you get a tax deduction. How good is that? So I always find it really confusing when people go, oh no, I couldn't bear the loss of my house. How many people do you know that you can talk to who have gone bankrupt or something because they lost a house because it burnt down or something like that? By far, the biggest reason for banks foreclosing on a home is financial hardship from loss of income because people got sick and they lost their ability to work. It's the number one reasons people lose their home is because of sickness, injury, and losing money.
Yeah.
So if you're going to insure a house because you can't bear the loss of it, if you hit financial hardship, you lose your ability to work, but you're probably going to lose your house and way, way more than that too. So it's something worth protecting.
Okay, and so you mentioned earlier that the default super ones sometimes are a bit lackluster.
Yeah. So there's a couple of sections to that. So there's a section of the Corporations Act. It's section 109, 109A, I think it is. And what it says, particularly when it comes to income protection, if you own it 100% through super, the law states that they can only release to you what you were earning at the time of the incident, your time of claim. So now if you were in your job going to work 9 to 5, that might be okay. If your income is exactly what you were insured for on the policy, that's great. But if you're insured for less than what you were earning, or the reverse, you may have had a great amount of insurance, but in the 12 months lead up to claim you earned less, they're going to pay you the lesser of those two amounts. But the big risk here happens to people who, let's say, for example, they have had an illness which has triggered lots of time off work, or they're a parent who's had parental leave and they've had time off work and they've just returned to the workforce, or they've been retraining, or they've been traveling and they've taken time off. If you look at the 12 months of your claim, and it could be far less than what you're currently earning at the time of the injury, but they're looking at the last 12 months. Now, this Section 109 clause, if you are a contractor and you are in between jobs, if you're a parent on leave, if you're doing sabbatical, or you're just an employee who happens to be in between roles, by law, if something happens to you in that time frame, the superannuation fund cannot release money to you, regardless of what you earned in the prior 12 months. That is a huge risk. And I spent 5 years specialising in looking after contractors, so that was a huge issue. And most of them didn't realise that risk applied. And it has got nothing to do with the quality of the insurance product that's attached to the super fund. It's what they are forced to adhere to based on superannuation laws. And the laws for superannuation, since it came out in the early 90s, have changed over 3,000 times. Whoa. So it's a huge legislative risk. Now, those changes are for all sorts of different areas, but super is subject to massive legislative risk. Okay, that's half the reason the FI community is, I don't want to trust super. I want it on my terms.
Yeah.
It's the same with income protection. Inside super, there's that clause. If you want to avoid that, you need to either own it in your own name or at least partially in your own name. And there's lots of mechanisms that you can do that. The other thing is this term called guaranteed insurability, right? So when super funds give you cover, they're not looking at you as an individual. They're covering everyone on a group arrangement. So what will happen is the super fund, trying to look after the interests of its members, will change everything on a group level. So the tender will typically only last for a couple of years and they'll stay with that particular insurer, and then they'll go out and see if they can find a better deal, or just simply it's up for renewal. And often what we're seeing in the last decade is the terms are continually getting worse and the prices are being hiked up massively. What is it in the last 12 months? UniSuper did 133% price increase. Australian Super, I can't remember the figures, but it was the high double digits. Host Plus income protection went up 67% recently. There was phenomenal increases, right?
Wow.
Most people don't read their superannuation statements. So all of these changes go through and there's huge swings, and they can change the terms to detriment anytime. What most people don't know is they could go to the exact same insurance company that their super fund is using and deal with them directly. Now, some insurance companies won't deal with individuals. You have to go through an advisor, but some will. But what you can do is you can go to that insurer and go, hey, I want life cover, I want TPD cover, etc., but I want to get my super fund to pay for it. I don't want to pay for it myself. You can do that. And the benefit of that is that because it's a contract between you and the insurer directly, it's not on a group basis anymore. So they, by law, they cannot change the terms to your detriment. They can keep them same or make them better. And they can't cancel it on you unless you stopped paying for it. You've got a greater level of legal protection there as well. And what I'm seeing over the last couple of years, the premiums for individual tailored covers is actually cheaper than the group arrangement, because people have always been sold this thing of, oh yeah, group arrangements are so much cheaper. Usually it's not. These days it's not. It's typically more expensive. So that's something people should be aware of too, that it's not what it used to be. So I think people really need to take a big look at that. But it doesn't mean it doesn't have its place. If you were going to get exclusions because you took out cover, or you can get it, then default insurance that you get through super, absolutely it has its place, but it shouldn't be your primary option. It's the backup option, not the first port of call.
Yeah, I actually had no idea that you could get income protection insurance directly outside of super. Wow.
Yeah, no, there's so much to it. I am an insurance nerd through and through. I've actually been focusing on it. I've been an advisor since the early 2000s, early noughties, let's call it. But I started specializing in risk in 2008 after literally 3 people that I knew. The first one of them died. They were all in their early 30s, and none of it I saw coming. Back when I was married, my husband, him and his couple of mates were running in the Canberra Times Fun Run. And I was waiting with the wife of the guy who ended up dying, and their daughter, she was about to turn 1 the following week, and he dropped dead 10 metres from the finish line. He had a cardiac arrest. He was 29 years old. And this is not a fat, smoking, diabetic person trying to run a marathon. This was a fit, healthy guy. He was a regular runner. And they didn't have enough life insurance in place, and they only had the default arrangements through super, and it definitely wasn't enough. It was enough to pay out the mortgage, but yet the trauma that she went through afterwards with the decision, I learned that pretty hardcore. And I carried a lot of guilt from that, because these were my friends and I didn't want to talk insurance because it felt salesy. Because let's face it, some people looking at the idea of dealing with a financial advisor is like the idea of looking at a used car salesman. They're treated one the same. They don't want to deal with them. Yeah. And I felt that pressure and I didn't want to be salesy. So I didn't talk to them about it. And then in the next 6 months, one of my friends was diagnosed with breast cancer and she was in her early 30s. And then another friend of ours who was a police officer, he was running and he had a stroke. And so I learned 2 things. Is one, running is really bad. Like, really bad for you.
Oh my God, I know I shouldn't laugh at that. But that's funny.
And then number 2 was that these things don't discriminate on age. Yes, they are usually older people problems, but they can happen to anyone. And I realized that the guilt I felt was really bad. So I was like, okay, I'm not going to avoid these conversations. I'm going to have these conversations. So I thought I'd maybe spend 6 to 12 months making sure my nearest and dearest were covered. That was in 2008. It's now 2021 and I haven't stopped. It's become my niche, and it's one of those things. It was important to me at the time, but the more I've specialized, the more I've realized the intricacies and nuances, and I'm always learning. And it's just built up my passion for the industry, and advocacy for client outcomes is so important. And so I'm involved in working with working groups that does advocacy for governments and regulatory bodies, trying to make sure that there's sensible outcomes for consumers at the end of the day. So yeah, it's important.
Wow. Yeah, no, I get it. It's such a powerful motivator for you. Thank you for sharing. It must have been a really difficult period to go through. And I can see where your passion comes from. You just want to help people, right?
Yeah, that's it. At the end of the day, it sounds terrible, but one of the things I love about it is that when someone dies, people do a lot to help initially. They bring meals around, they put them in freezers, there's flowers, there's that kind of stuff. But after a couple of months, life goes back to normal for everybody else except the person that's been affected. And grief isn't something that most people are trained to deal with. And it could be the Father's Day and people are like, oh, I lost their husband. I don't want to call because I don't want to remind them that their spouse is dead. It sounds really hard, because trust me, that person knows. And having permission to be able to talk about these things and to not feel like it's a problem to be heard is really important. So some of the things I've done is training on helping people with grief, and I've learned a lot from that as well. So yeah, it's just so important. And like I said, life insurance, it's not going to change what happened, but boy, does it give people some dignity and some choices. Yeah, it's really important.
It sounds you probably need more than you think you need when it comes to insurance.
You need choices. That's what you need. You need choices. And if you choose not to do something, that's okay. At least you made that choice.
Yeah.
So that's your life. That's your income protection. You've got your income protection. And actually, speaking of income protection, a lot of people don't really understand how it works. Probably the biggest risk that people saw with COVID, who's tried to obtain their own covers, try to submit claims because they lost their job. Income protection is not employment insurance. It's your ability to work insurance. The way income protection works, it's based on a time excess. So if you claim on, say, your car, your home, your health insurance, it's all a dollar-based excess. Income protection is time excess. So you choose how long you want to use your own resources, whether it's sick leave, annual leave, your savings. And then after that point, that's the waiting period you choose. If you're still sick after, that's when you want the insurance company to kick in and take over the responsibility. Now, as far as coverage on income protection, is literally based on the advice of your GP. So if you go to your GP and they say, look, you should not be working, they might say you should stop completely. They might say, look, you need to cut down to maybe 50% of your hours. A good and quality income protection will pay out in both scenarios. So if your doctor says, look, at the end of the waiting period, you still off work part-time, well, yeah, you can get part of your wage from your employment and you can get a top-up from the insurance company. It doesn't have to be all or nothing. And that ability to work, it could be because you've got depression, it could be you've got cancer, it could be you've got an RSI problem, or you've got glandular fever, all of those things. If you have an inability to work because of a physical or a mental reason, that's what income protection is for. And that's why it's so good, because it is so broad what it covers you for.
Yeah. So most in the fire community, we talk about those resources initially being, say, emergency fund and annual leave or long service leave. What I had previously done was, I kept about 3 months worth of leave up my sleeve, and
Awesome.
rather naughtily, I kept very little emergency fund. And I'm looking back and realizing how dumb that was. I really should have kept more cash. Maybe it was ignorance or call it the exuberance of youth, but I thought, damn, I want to get a higher rate of return than my 1% in the bank.
I sympathise. Interest rates are so low, you just wanted to do something more, right?
Yeah, and then I got that positive feedback where I had invested it and the market kept going up. So I'm like, oh, great. The stock market is my emergency fund. So I built a good portfolio of ETFs and I kind of self-insured my emergency fund. But yeah, now I'm no longer flying full time. I'd like to maybe go back to doing some flying instructing or a little bit of casual scenic flights, those kind of things. So I'm not forever saying I'm not going to earn an income, but I know now I probably want to keep a bit more of an emergency fund. I'm aiming to keep around 10 grand. And I know that number is irrelevant to everyone because it really depends on your personal circumstances. But I think the general accepted is somewhere between 3 to 6 months worth of living expenses.
I think it makes a heaps of sense, because as far as income protection goes, most people don't have decent buffers. So they would typically need maybe a 30-day wait. That's a stock standard in the industry. But if you have a 30-day wait, like I said, the first 30 days, you're on the hook for the whole amount. After that, the insurer's on the hook, but you don't get paid day one from the insurer. They would typically pay a month in arrears. So 1 month wait is really 2 months of no money. But if you have the ability to if you've got 3 to 4 months worth of emergency buffer living expenses, going from a 30-day wait to a 90-day wait will drop your premiums by about 40% when it comes to income protection.
Yeah,
that is a solid saving, right?
That's a no-brainer, right?
Yeah, though interestingly, it varies by the insurer, but typically if you go from a 90-day wait to a 2-year wait, the savings aren't there. You might maybe save 5 to 10% max from extending that wait period.
So 90 days is 3 months, right?
That seems to be the sweet spot. So sometimes I come across people and they're like, oh, I've got 8 months of saving. I'll have a 6-month waiting period. And I've run the quotes and the difference in premiums is like $1.18 per month. And I'm like, you've just thrown out, if your monthly benefit is grand, that's 3 months worth of benefits. It's like you're giving up $18,000 to save $1.18. I didn't think of it that way, because if you've got that exclusion, you're obviously not getting paid the benefit for the period in that window. That's just a no-brainer. You're giving up 3 months worth of benefits to save literally $1 or $2. So usually people having a 2-year wait, it doesn't really make much financial sense. You might as well just have a 90-day wait.
Yeah, okay. And so that was what I thought. And so when people ask me, I said, look, I would feel comfortable somewhere between a 3 to a 6 month emergency fund. And I guess if you had kids or you didn't have as much assets behind you, you probably want
to something shorter.
Yeah, shorter waiting period, and perhaps you want to consider a longer emergency fund.
It's good motivation. 40% saving. If you called up your whatever other insurance provider and they went, as long as you've got an emergency buffer a couple of months you're prepared to use, we'll drop your premiums 40%, and you'd be done.
I think you should remember that your leave from work, if you have an annual leave entitlement or a long service leave or any of that kind of stuff, you could include include that as part of your emergency fund as
Oh,
well.
absolutely. And that's one of the things that we work on in terms of working out what someone's exposure to risk is. If your income stopped tomorrow, literally, what have you got that's going to plug that gap? And for most people, that's the first thing I'm like, okay, let's go to the thing that literally costs you nothing. What have you got in terms of sick leave, annual leave, long service leave? What have you got, obviously, that you don't have plans to use in the immediate future? And then after that, what savings have you got? Or what other resources can you draw on? Because it's amazing. I've seen a lady who's had like $100,000 just sitting in cash. And I said, oh, yeah, surely we'll be happy to draw down this. And it was like an inheritance. And she had been unwise with spending in the past and had gotten down. And it had taken her so long to get it back to that amount. She couldn't bear the idea of touching it. And so we went with a 30-day waiting period because it was emotionally traumatic for her to do that.
Wow.
Whereas I've got people who might have done the opposite. That it's taken them 5-6 years to save up something as simple as $10,000. And they're like, you know what? I'm happy to lose it all. I would rather use it. So you can't assume what someone is comfortable with doing. So just ask people and go, hey, you've got this. Would you be prepared to use it? And if they say, yeah, I'm like, great, let's bank on that. And that can save you some money. So yeah, it is definitely an individual consideration. And for those in the fire community, if you're at a point where, like I said, if your income covers your expenses, income protection is not a necessity. You may not need it at all. I do have a couple of people who still choose to it because they have hit fire, but they still have aspirations for a more luxurious lifestyle, and that depends on whether they go further. They could absorb it, but they don't want to. They choose not to. Yeah.
Okay. No, that's a fair point. The other one was the TPD.
TPD. Yeah.
And the thing here as well is I've thought about this myself, and I'm like, okay, cool. So I'm fire, and I'm happy to get around town on my bicycle, my e-bike. I don't have a motorcycle anymore, so I get my kids on an electrified bicycle. It goes really fast, by the way. I can get it.
An electric bike as well. It's decent.
E-bike. Yeah.
Oh, Facebook Marketplace too.
Look, I got mine from Marketplace as well.
Yeah.
It's so good. But yeah, so I hoon along on those. And the thought occurred to me, if I get cleaned up by a bus or something and I'm in a wheelchair and all of a sudden maybe I need a carer to help me eat or go to the bathroom.
So many considerations here. Yeah. So what you want to think about in this scenario is there's a couple of elements, right? A lot of people get confused about, well, do I even need TPD insurance if I've got income protection? And so the answer is it depends, but for most people, yes. So if you think of income protection gives you cash flow, it's not there for lump sum payments. It's just a security of cash flow. Your TPD is the opposite end. It's the same as it's also based on your ability to work, but it's the opposite. Instead of being a cash flow solution, it's a capital injection. So it's for capital expenses. So the way I look at it with people is if they've got a mortgage, we look at their income and say, okay, once again, if we got rid of your mortgage and you didn't have to make repayment, that can be a great way to offset the loss of income, because even if you have income protection, if you can't save at least 25%, because income protection covers 75%, at the moment anyway, it's actually going to drop come October with some industry changes. But at the moment, and for a long time, it's been 75%. So if you can't save 25% or more of your income, then that's a problem. So if we can get rid of someone's mortgage repayments, that's immediate cash flow relief, and that can help plug that shortfall. Also, I get some young people who have yet to purchase a home. And the discussion we have is if you were permanently disabled, you could never work again, how important is it to actually own your own home? And usually people are like, I want security at that point. So we go, okay, well, you need to be able to buy a home outright, but what bank is going to lend you money if you're on income protection payments? It's going to be pretty hard, right? So we just simply say, let's make sure that you're out of the rental trap, you own somewhere, and then you can just pay it outright. And then whatever you've got from income, whatever your income sources remains for income, and that can cover your expenses. So that's a big one for a lot of people. If people have consumer debts, credit cards, car loans, it's a good way to get rid of that too, take some pressure off. Otherwise, it really becomes about what are the costs associated with this injury. So if you own your own home, whether it's outright with a mortgage, chances are if you've got a disability and it's a serious one, you're going to have to modify that home, and that can cost a lot. So it could be ramps, it could be widening all the doorways in a house, it could be completely knocking out a bedroom to make it a really super to extend the toilet in the bathroom to make it wheelchair access as their allowance, and it's huge.
We actually had to do this in our family home for my grandma. She became wheelchair bound, and we did that. We knocked out a wall, made the bathroom bigger, and
because the regular sized bathrooms won't cut it. Not with all the stuff.
So expensive. My mom recently retired, and we were looking at her super and paying off the mortgage. And I looked at the mortgage and I'm like, Mum, this mortgage is higher. You owe more now than you did 20 years ago when you bought the house. And she's, oh, yeah, but that's because we had to keep paying for remodeling the house for Grandma. And yeah, so I was shocked at just how expensive that kind of stuff was.
Yeah. So having a capital injection to make your home disability friendly, and like I said, it's not just the ramps and the bathrooms. You might need bench tops lowered for somebody who needs to be able to prep things. You always want all the light switch lowered. There is so many things that you could potentially need to change to a house. Or if you're, let's say you're in an apartment, a tiny apartment in a multi-story building, you might just go, screw it, I'm just going to have to sell it and have to buy somewhere else completely brand new. And then you've got your agent's fees, you have to pay stamp duty all over again, and you want to make sure that you can live somewhere suitable. So having a capital expenses, or even, hey, you might go, I still want to be able to drive. You can actually get paid to get cars modified so you can still drive if you're in a wheelchair. So there's things that you can still do. There's a pretty price tag attached to it. So there's that element. And then there's the long-term stuff. If you need long-term ongoing care, one of the biggest questions I get asked is, well, what about the NDIS? Yeah, the NDIS is there, but it doesn't cover all disabilities. You have to be able to fit in their boxes. So I've got one of my clients, she had a stroke and she gets a huge amount of NDIS funding, but that's because she needs carers 24/7. And even though she's married and even though they have that, her husband is exhausted, like he is exhausted. And then I've got somebody else who has complex PTSD and now they can't drive anymore. There's a lot of things they can't do, but they're not covered under NDIS for that. But they're forking out huge amounts on Ubers and taxis and assistance and spouse taking time off work. There's a lot of inconvenience. So long-term care costs, if you don't want to rely on the NDIS or you're more worried about covering the impact of something that's not on their NDIS, a more moderate level, then that could mean your spouse becoming your carer and they've lost potentially their income. It could be you just go, you know what, if I've got, for example, I see a lot of women who've got MS, like the idea of trying to maintain a household with that. They want someone else to do the yard work. They want to clean it once or twice a week. They want someone to come to their house and chop vegetables so they can still meal prep, but it's easier. Things like that. And that all comes at a cost. So people want the ability to make my life easier and outsource a lot of services. So we include an annual budget that an insurance, like a lump sum, could produce an income stream that would give them an extra revenue stream so they could pay for things that they don't currently have to pay for. So TPD is about, the initial shock and then managing the long-term changes that you want to put in place.
Wow. I had a question, Katherine, that I was going to ask you, right? And I feel so ignorant now. I'm not even going to ask it. Because I just feel so stupid now. I was going to ask you, how much is enough insurance? And from everything we've talked about today, there's literally no answer to that question.
It's a personal value question. It really is. It's a personal value. I'll tell you one client. I have one client who was earning a significant amount. We're talking combined family income from employment was approaching $750,000 per year. So significant value that was brought to the family. And we had this conversation about what outcomes do you want with TPD insurance? And he said, look, the only thing I want is to pay off the mortgage. That's it. And I was like, what about the care costs? And he goes, honestly, if I'm TPD'd, I'm going to drive myself off a cliff. And I was like, wow. So what's my ethical obligations here if you ever actually become totally and permanently disabled? Do I have to inform someone? Because he was dead set serious. I would not want to live my life disabled and I will take care of that. I don't want ongoing care costs. I will end my life. And that was a very confronting conversation. That's the way it was. So like I said, it's a very personal conversation about what outcomes you want.
Yeah.
So
that's pretty confronting. All in a day's work for an advisor, hey, Katherine?
Oh, yeah, you have no idea. I think I had one day where I had 3 people who went through really traumatic events and just listening to their stories. I wasn't okay for about 2 weeks. I still went to work, but I couldn't switch off my mind from those events. I needed to download with someone. And like I said, people talk about to be an advisor these days, you've got to have a financial planning degree. So the industry has changed so much. When I first entered the industry, you could literally do a weekend course and then you were a qualified advisor. And I'm like, wow, that's really scary. And that's where we saw a lot of these outlandish behaviors come from. But there's legislation got passed ages ago and it's all coming. We've got this transition period, but to remain in the industry, you have to get a degree or you get out. I was lucky that I went above and beyond and got qualifications well before it was mandatory. So luckily I don't have to do that because I've already met the criteria, but there's a lot of people leaving industry because they can't. And actually something that I think I'd like to point out, because It's a really big misconception, and I see this on any kind of forum, whether it's Barefoots, where it's Aussie Fire, like anything like that. When people talk about seeing an advisor, they're like, oh, be careful. They're just going to recommend you superannuation so they can get a commission and stuff like that. Commission on investment, like built-in commissions on superannuation investment products, hasn't existed in ages. If you go to see an advisor and if they're set up to work with a superannuation fund, there's no commissions built in. That doesn't exist anymore. They may charge you a fee, and so they should, because they're providing you with a service. But that's entirely negotiable and about you finding a fit for them. But yes, those built-in property sector, wow, that's a different, that's a very different story. But that's not part of the regulated financial advice landscape. So so that's something that people should be aware of. And it doesn't mean that just because someone's charging you fees instead of commissions, it doesn't guarantee that they're ethical. They could be really lazy and just be giving you a one-size cookie-cutter fits-all approach and not really considering and just making you fit their strategy rather than what's right for you. But that will exist in any profession. So you need to find someone you're comfortable with.
Yeah, I had a couple of bad experiences with advisors, but I linked in with one now who's pretty cool. I'm actually glad I did, because am I on the right track here? And I just wanted to try and work out what level of risk I have with my FI portfolio. Because it's funny, we talk about risk, and I was like, I've got these investments, they're creating this income stream, and I'm like, what is the risk that this would all stop and I would have to go back to work? So that's what I'm going through to see with them. But I would say my attitude towards advisors is changing. It sounds like, from what you're talking about, it almost sounds like advisors need some kind of like psychology or counselling degree as well.
That was the point I was going to make, is that there's been a lot of arguments saying that it would actually probably be more relevant. Obviously, we need to know the legislative law and legal aspects, and that's part of our education requirements. But a big part of it too is we need psychology. I think that should be more in the framework than it was. And I had a client call me up this morning, called me and said, I'm not okay. It was actually her husband who called and I missed the call, and just said, this is what's going on and I'm not coping. And so it's almost like the call you'd expect to be if you're on the other end of a call from 1300, like a 13 lifeline type number. And you have those conversations with people and going, okay, no, this is what I can help you with. And these are the options that you've got, but you need to go get this medical advice. But I'm here for you. You see people at their worst. You get to see people's best intentions, which is awesome because they want to take care of themselves and their families. But when things go badly, it's, like I said, everybody else can bring meals and flowers and that kind of stuff. I get to rock up with a check, though I haven't actually handed a physical check in a long time, but I do get to rock up and say, hey, we planned for this, and when you're ready, let's talk. And then it's a conversation of going, okay, we planned for this, and do we still want these outcomes that we spoke about? Because there's no reason, if I do a strategy for someone and go, this is how much insurance you should ideally have, there's no requirement when they get that money, they have to spend it that way. But it can also be really reassuring for them to go, I've got all this money and it feels a bit of a shock and I feel guilty because I'm getting it because my spouse died. I don't want it. Take the money back. Just give me my spouse back. That kind of stuff. There's a lot of guilt from that they feel like they might be benefiting in somehow.
Yeah.
But it's no, this is what we did. And some of that, sometimes that's just to say, let's not make a decision for 6 months. Let's just let it sit there knowing that's okay. Maybe we'll pay off a mortgage, but the rest, let's just not do anything until you can make a decision, and I'll help you guide there. And the dangerous thing is a lot of people will come to you once you get a payout, doesn't matter the source. And even if it's life insurance, a lot of people will come and should all over you. So you should do this, you should do that. And so I have to say to people, look, people are going to should all over you and they just want to help. Take down their notes, but don't act on it. Come and discuss it with me and we'll go through, because people are well-meaning. It was the path to hell is paved with good intentions. So you got to sound it out with someone who understands the implications. So that's something important that we do with as well. But yes, psychology is very relevant to what we do.
It sounds like the job isn't simply transactional, like, hey, I come, I pay my whatever statement of advice, get the products.
Yeah. It's
not really, okay, off you go. It's literally like a lifelong relationship with a good advisor.
Yeah, absolutely. And that's the thing when it comes to advice relationships. For example, for me, because I specialize in insurance, I see people and I might help them out, and it's quite intense at the beginning, getting them help, getting covered. There's a lot of hours involved on our end, but then we might not deal with that person for a couple of years because it depends. Whereas I've got one person who sees me every 6 months who really needs a high level of security, making sure everything's okay. It just depends on the needs of the person and the changes going on in their life. So I would generally tell people that some people will need an annual review, but most people don't, especially when they're young. If you have an injury or if you get a big pay rise, you've got an inheritance, or you smashed out your mortgage and you need less cover, or the opposite, you take on a bigger mortgage, you have kids and we need to make changes, then absolutely a review is always in order. Whether there's changes or not required, that's another thing. But if nothing is changing in your life, tiny things do add up over time. So your superannuation going every single year, your mortgage coming down, kids becoming less dependent, these things add up and have a cumulative effect on how much cover you actually might want to have. So I tell people, look, even if there's no big changes, we shouldn't leave it longer than 4 or 5 years before we catch up and have a chat, even if it's just to go, yep, keep on keeping on. When somebody comes to see me, I'm not the someone who likes to go, oh, look, here's the best deal this year. Let's jump to the best deal next year. I find that's very rarely in people's best interest. I'm usually trying to find a deal that's going to fit them for a very long time, because there's this thing called, it doesn't make sense in all cases, but for a few people, level premiums means that when you take out your cover, you pay a bit more to begin with, but the insurer guarantees that they will only ever charge you the rate that applies to your age when you took it out. So I have a trauma insurance policy I took out when I was 21. Super nerdy, even at that age, even though I didn't work in insurance. And that policy, I can't remember how much is exactly, but it's in the high 100,000s territory of how much trauma cover I've got. That policy cost me only about $200 per year. And I'm starting to enter the higher claim age range. But even when I'm 60, I'll still be paying the rate for a 21-year-old. Now, that doesn't mean that they can't change the rates. They might look at 21-year-old female office workers and go, oh, we think that category is a bigger risk, so we need to dial up the premiums. But they could also just as easily turn around and dial them down too. But the key thing is they only pay the rate for a 21-year-old. And then I took out income protection, other things in my mid-20s and a few other things. But once again, I could not get the pricing I have on those policies right now. You can't get that because I'm no longer that age. So I paid more initially, but it's absolutely paid off. And now I'm at a point where I have actually a stupid amount of trauma insurance. Trauma insurance pays out on diagnosis, and the biggest one is cancer. And I am a redhead, and I did not have a sun-smart childhood. So the way I look at it is it's not if, it's when. I know it's very much knock on wood, but at this point, it's almost part of my investment strategy. And that sounds terrible, because if something happens to me, I have way more than I would possibly need, but it's my odds of claiming on my trauma insurance for any normal person between now and 70, it's about 1 in 2, right? Given I'm redhead, fair skin Australia, my odds are higher than most. So for me, I feel like it's not if, but it's when. And then when I get that, I'm going to get a huge tax-free payout. Not that I want it to happen, but I expect it to happen.
Yeah, it's a smart financial planning for your future.
Yeah.
That's interesting. Okay, so we've covered the main kind of insurance groups. You talked a little bit about trauma insurance as well, which is something I had no idea about.
Yeah.
I'm going to throw this random one out because I've always thought this was a dodgy one. What about pet insurance? Is pet insurance, is that a scam? Because I thought it was a scam.
Yeah, look, I've never taken it out. And I'm going to say all things hindsight 2020, I needed it at one stage and I didn't have it because I'm a planner. I managed just fine, but I should have had it. But the reasons were very specific because I had a dog that was really terrible about escaping, breaking out. Someone would come and visit the house and he would almost like he could know they were coming, and I didn't have a screen door, and he would just dash and he'd run down the street
like
and
turn
had
into
no road
water and
sense.
just like get underneath the door.
Oh yeah, and he just zoomed, and then you like, please let him come back in one place. And he was doing this for a year. And one day, he got hit by a car, and I'm like, you know what? I do think pet insurance is rubbish, but the behavior of my dog indicated that I probably should have had that because he was a risk for that, and I wasn't able to secure the yard for the area that he was accessing.
My sister's dog, we refer to her as the $12,000 dog because the same thing happened. She got hit by a car and it was $10,000 to get her leg fixed.
10 to 12 grand.
Yeah, we just couldn't bring ourselves to put her down. It was like my sister's best friend, almost like a disability companion dog. And so, the family just
pitched in,
just coughed it up. Yeah, but don't write off pet insurance, but maybe just critically analyse if you need it or not.
Critically analyse, where's the risks? I should have had it based on the risk that was there. I did consider it at an early stage, and I looked at it, and obviously it's very breed specific because some breeds are notorious for problems, so your premiums vary. But I went through, what really put me off is I did actually go through a couple of policies, and I looked at the annual premiums, but then I went through the clauses, which was talking about the max payments that you could get. And it was so restrictive. And even one of them was like an ancillary feature, which covered the vaccination of your pets and stuff like that. And I worked out, and it was capped at something like pay an extra, it might have been an extra $50 a month. So we're talking $600 a year. And you'll get all these features, these extra care packages that will be covered. And then I read the clause, and we will pay out a maximum of $450 in these scenarios. So I'm like, wait, so you want me to pay an extra $600 a scenario to get $450 back in benefits. I'm like, that doesn't work. And even though the things that you would use, there's still a $150 gap. So why don't I just put the $50 in a bank account and I'll spend $450 a year when I need to, and I'll pocket the $150 difference. So there was things like that. So I found some really restrictive policies. It's all things. There will be people who have benefited from it. Absolutely. But I think you have to be, like all things, read the fine print, understand what's involved. That's a really big thing. But the biggest thing that frustrates me about pet insurance is that people will insure the pets before they insure themselves. That's what drives me mental.
Oh, yes.
Yeah, I get that pets are an emotional thing, but at the same time, other people will be emotionally affected if something happens to you. If you've got a parent or a child or a spouse, you will be an emotional mess, and so will many more people. If you can't imagine this happening to a pet, then you need to get yourself services on the airlines. Put on your own oxygen mask first before you start helping other people.
Absolutely. Yeah. Okay. No, I like it. Focus on the most important thing. Look, you alluded to before that with our insurance, you obviously have some through super and some outside. Can you have it all paid through super? How do you finance the
covers? Yeah, sure. So the only insurance you can't fund from super is trauma insurance. You must pay that from personal cash flow. You don't have a choice. That's part to do with superannuation legislation. Your life, your TPD, and your income protection, you can 100% fund all those through superannuation, whether that's a group arrangement with your fund or you go direct and then get them to pay the premiums from whoever your current superannuation provider is. However, that being said, like I said, I find income protection through dangerous. The whole point of insurance is risk transference of risk, getting rid of risk. But in my mind, there's too many risks associated with having income protection 100% through super. So what we've seen in the last sort of, maybe it's been about the last 7 years, insurers started coming out with this thing because obviously cash flow is king. So what they said is, okay, how about we give people the ability to have an income protection where the majority of the premiums are funded through super. But anything that doesn't meet the superannuation law requirements, it can be the one policy, but we'll pay it, you just pay that personally. So a case example of that is if you have income protection through superannuation, by law, sick leave offset payments will impact your claim. But if it's owned outside of super, that can be a condition of your policy that it's not offset. So I had a guy who he injured his hand really badly, and we had this what's called a split policy. And so we lodged the claim, and they went, we have to assess it under the super side first, but under this, because he's getting all these benefits from his employer, they're giving him sick leave. Superannuation law says we have to deduct the payments from whatever the employers decided to pay him. And because they were doing 100% of his wage, at least initially, they're like, you get nothing. But because we own part of the policy outside super, they said this gives you payments that override the first one. So the guy did get paid because part of it was owned outside super because we had a clause that override the other one. Also, things like elective surgery can be an issue if you've got cover inside super. There's things called specific injury benefits. I love those. For example, if you fractured something, I see mountain bike riders fracture collarbones all the time. Netball is not considered a contact sport, but boy, is it vicious. People damage ankles and stuff all the time. But for a lot of office workers, they go back to work the next day, right? They might have a trip down to ED and then they're back to work the next day. Tradies, it's different. For office workers, you get a cast, you go back to work. And this particular feature basically says you broke this specific bone and this is how much money you get. And you get a payout even if you didn't take time off work. You can't have that through super. You have to have that. That's a feature of a policy that's only owned outside of super. So that's a really good way of structuring to get the best of both worlds. So if cash flow is tight, you can use your super to cover the majority cost. And then whatever you need to get that extra security to avoid the superannuation legislation risks, you pay for that personally. And that part you generally get a tax deduction for. Now, the big thing that's important with this is anytime you fund cover from super, doesn't make it free. You're just paying for it with a different asset, right? You're getting rid of your future retirement income. You're like, that's impacting that and taking off your current income needs. Then when you've got your life and TPD insurance, once again, you could do it your own cash flow. You could do it through super, but most people do it through their super simply because it's easier. That's usually where they started getting their first life and TPD cover. But something to consider is if you put life and TPD in your own name, you don't get a tax deduction, at least not for most people. If you put it through super, there's no tax deduction there either. However, if you want to offset the impact, of the contributions against your super balance, you can make top-up contributions to super. And for a lot of people, they can get a tax deduction to do that. You can salary sacrifice to super. So if you went, oh yeah, my premiums are $1,000 a year, then you could just go and salary sacrifice an extra $1,000 a year to your super, and your premiums have suddenly become tax deductible in a very roundabout way. So that's a strategy that a lot of people use to tax effectively pay for their
yes. So instead of paying your normal marginal rate, you'll just be paying the 15% through super. Yeah. So for high income earners, it makes sense to do so.
Yeah, exactly. Even for lower income earners, it can make sense. There's a strategy where we look at, because if you do this setup where you go to the insurance company direct and you fund it through super, they will apply usually a 15% discount if it's been funded from super. Even if you're a lower income earner and it doesn't make sense to make salary sacrifice, if you're a low income earner, you might put $1,000 into super. You don't claim a tax deduction, but you may get the co-contribution. So there you go. You suddenly got, you put 1,000 in, the government puts in 500. There's your premium covered, plus you got a 15% discount on your insurance. So
wow.
So there's income tiers across the board can benefit from one strategy or another.
It sounds, again, coming to the conclusion that there is no one size fits all, and it's best to go to a professional and have a professional do all these numbers for you.
Yeah. Like I said, product is the solution that we use. But the value of an advisor is not product. The value of an advisor is the strategy. Strategy, yeah.
Okay, look, this has been awesome. I want to shift gears a little bit and just talk a little bit more about yourself now, Katherine, if that's okay.
Yeah, sure.
So you mentioned that you hadn't always specialised in risk and insurance. I just want to ask, is there anything you wish you knew before you began your career in finance?
Oh gosh, I was lucky that I got a big warning at the very beginning where I actually didn't choose this career. Somebody else chose it for me and I just went along for the ride, and then life happened. But the biggest thing, I was told that it's a love-hate relationship because the learning never stops. Legislation evolves constantly, strategy, legal environments, product changes, it all changes constantly. So it's a job that you never get to stop learning. So if you are attracted to that, then it's awesome because you're engaged by it. If you're overwhelmed by it, it's not a good choice. So I was given a heads up of that. And I do sometimes I have love-hate. It just depends on how fast the change happens. But for me, the biggest thing was that I always knew eventually I'd be in business for myself. And I think words to the wise, I heard someone explain it really well and it made so much sense. A lot of people go into business for themselves because they want work-life balance, because they want to take control of their working hours and stuff. But what ends up happening is the exact opposite for most business owners. They work longer hours, they're more burnout, they're more tired than ever before. I think I wish I had known before I went into business. I'm glad I went into business for myself, but I wish I had known just how much extra time. It's literally like you've started taking on a second full-time job, or at least a part-time one. And I think that's something that most people don't realize until they're into it.
I saw a meme and it was like, what was it? I was sick of working 9 to 5, so I started a business and now I'm working 24/7.
Yeah. It's funny. I was in WA recently and I was supposed to be there on holidays, but they changed the border restrictions as I was boarding and I ended up spending the entire time in quarantine. And anyway, but it was people like, what? You're going on holidays, but you're a business owner. You don't get holidays. And I'm like, shut up, I'm going on holidays. And I was so annoyed. The phone did not stop ringing the entire time. And I actually hit my mental health a bit. I was feeling really resentful. And I thought, man, if I ever leave my job, I am doing a job that when I leave, literally I'd be a cashier or something. I will leave the job and I will not give it a second thought. And the only reason I would do a job like that is because social benefits or something. But yeah, that is only the one thing something that people should be mindful of if they're going to business for themselves. Some people do get 100% passive aspect with their business, but that's pretty rare. So I think people need to go in eyes wide open and know that there's a lot of time involved and obligations when you go into business for yourself.
Yeah, very wise words. So this could be opening a can of worms now, but you sort of touched on it a few times during a conversation about your personal investing preference and your strategy. If you're going to talk in general terms about your personal investing preference, how have you done it and what do you personally invest in?
Oh gosh, mine has evolved heaps. I've owned investment property. My current strategy is shares. I like direct shares, and I've done managed funds. I'm a big fan of managed funds for debt recycling purposes. But right now I'm just focused on shares. I've owned ATMs. I've tried all sorts of stuff. It would have worked well, except the people that ran the company were doing the dodge and selling the same machines to multiple parties. So they did the dodge. Yeah,
Okay,
but
that's
but
not
the whole
great.
thing, the concept was sound, the execution was illegal. so,
Yes.
so yeah, that sucked. Yeah, so for me, I'm a thematic investor. I focus on themes, and so exchange traded funds and all that stuff is good. It's very passive aspect. But I am a little bit of quite risky and aggressive with things. I like picking on themes. So my current theme I'm focused is on this medical stocks I've got, which I will never buy a medical IPO because most of them tank. I wait until they've done their thing, tanked, go to penny stocks and play around with that, especially when it comes to cancer drugs, because obviously that's related to my job. I like to be informed about cancer drug developments.
Yes.
And then the other one is I'm really big on gaming tech. I think esports, mobile gaming, that kind of stuff. That's for me, I just look at the behavior around me. I will only invest in what I understand. And
Yeah.
for example, I invested in Zero at one point because I used the accounting software and I got it. I've since sold that stock. But things like I look at my kids and the amount of money people are spending on mobile apps and stuff like that. I'm like, I want in on that. So
Oh, yeah,
yeah.
you should talk to Matt and Liz Rard. They've been training me in some of the website stuff. But Matt is so big into the gaming stocks, and not
Yeah.
necessarily the games, but the tech behind what's
Yeah.
allowing the production of the games.
I just feel like it's a growth area. And I'm going to say I would never advise someone on I don't do that as an advisor. But for me, it's like I said, I'm quite aggressive with the way I invest. It works for me, and that's what I feel comfortable with. And I like the control around the admin part. I hate, what do you call it? Share purchase plan offers, corporate actions, and dot dot dot. But thank God for platform providers and whatnot can consolidate all your tax reporting for you. But otherwise, probably my biggest thing I focus on investing in is my own business. I run the numbers and I look at it, and it's for me, my business is where it's at. That also comes with legislative risk as well. So I'm really big on making sure I've got super, I've investment bonds, I've got shares, I've got managed funds, all those things, focusing on getting as debt free as fast as possible. All that sort of stuff. I think you should never rely on one source. It's good to spread for legislative risk as well as investment risk. Yeah.
Yeah, it sounds like you've got a highly diversified portfolio. So yeah, it's nothing to do with ADHD at all, Catherine, is it?
Yeah.
No,
I don't know. Like,
understand.
yeah, it's funny. I've learned so much ever since I did get diagnosed, but it explains so much. But I love to jump at opportunities, and I'm also someone who learns by doing. You put a textbook in front of me and I struggle. Living it, breathing it, doing it is the best way for me to
Kinesthetic
learn.
learning. I'm the same.
Oh, absolutely.
And
Yeah.
like when I'm teaching people to fly, you can only read a book so many times, but get into the cockpit, you smell it, feel the vibration. It's completely different. Yeah, I'm the same. So look, I got to ask this question. I ask this to everyone. Right? What would you say your top tips are for someone who's on the path to financial independence?
My biggest one would probably be surround yourself with people who are on the same journey as you. Because literally, if you've got people who are resentful of your progress, that's going to cause stress and strain and tall poppy syndrome, or they can try to pull you down. People don't like other people being different to them. Find people who are going to inspire you to keep on going, because I think sometimes, especially when you're dedicated, you have to give up things sometimes. Like, there is an element of being smart, but there was also you're giving away some of today's pleasures to focus on a greater reward for tomorrow. And that's hard. So if you can find other people who are also into that and can inspire you and encourage you in areas that you want to be encouraged and keep you accountable, I think that's invaluable. The other element is it's never too late to start. And even if you feel like you can only start small, and be like the frog in water, except this is the good frog in water, because instead of being boiled to your death, you make small incremental changes so you don't feel it and you get where you want to go. But never too late to start. And the earlier that you do start, mathematically, the easier it will be to catch up on any shortfall later on, if there is one.
Absolutely. I always get annoyed when I look at the compound interest charts that say, oh, you start at 20 versus you start at 25. Because I started seriously investing in my mid-20s and I was like, damn it, why didn't I start this when I was 17?
Oh, man. Yeah. Or I see a lot of people like that now, except we're having the conversation with 40-year-olds who are going, oh, why didn't I start when I was 30? So it makes a difference over time. And yeah, you can catch up, but mathematically it's a lot harder. So the earlier you start, the better.
Yeah. I love your comment about the networking and surrounding yourself with successful people. Someone told me once, if you're the smartest person in the room, you're in the wrong room. So you should go and find a new room, people that are going to help bring you up. So I think that's very wise. So I guess my final question, Catherine, I'm interested to hear, what's been the biggest influence on your journey to financial independence?
Probably my parents. I think there's a lot of similarities between yourself and I, because my parents, when we came to Canberra, I want to say my dad sold the farm. It was a case of, yes, he sold the farm to his brother and he's like, oh yeah, just pay me when you get the money, which was never. So that meant interest rates were ridiculous in the high teens, and we rented a house and I think we didn't even have money for furniture. So I remember the first 6 to 12 months we all slept on the lounge room floor in the same room. And people would drop off boxes of food at our house and we couldn't do a lot of it. I felt poverty, if that makes sense. I was very conscious of it. And even for years later, I watched my parents make decision about how often we could afford to wash our clothes. And my mum would even make her own laundry powders to try and spread it out further. Things like they'd want to take us on an outing, but one of the parents would have to choose to miss out despite wanting to go because they really had to skimp and save. And there were situations where money did come their way, but they made some really bad decisions. And I remember looking at that and I just saw the stress that it caused my parents. I didn't feel like I lacked as a kid, but I certainly saw the stress that it had on my parents. And I just remember growing up thinking, I don't want to be like that. I don't want to have to face those choices. So I want to learn everything I can about money to make sure that when I get it, I don't have to work for money, works for me. So I'm a really big believer in that. So yeah, I don't want money to dictate my decisions. So I figured if I can learn to be in charge of it, then that will give me options and means I don't have to deal with those scenarios. And so that was a really big motivation for me. But as far as where I've learned things, obviously being a financial planner, I've literally had to study it at a university level. And then you see what works for people, and it's peer networking with other advisors. And I've learned some strategies from accountants. I've done my own diggings. I've made mistakes like with the ATMs, all sort of stuff. Kinesthetic learner, I've learned by doing a lot as well.
Yeah, I really appreciate you sharing that. It's obviously an incredibly personal story about your childhood. And yeah, I feel the same way. There were Friday night, hot chip night. That was like, woo, that's a celebration of the week.
Oh,
right?
ours was spaghetti pizza. Mum made the base from dough and water, and there's nothing to put on this pizza. So let's use a tin of spaghetti.
Yeah. Oh my goodness. Do you know, I'm making pizza with my nephew tonight. Once we finish. I've made some sourdough base. We're going to try and make our own pizzas. So it could be a disaster, but let's see how we go.
Yeah, no, I love it. I've become a bargain hunter. I actually get very excited about finding good deals on things these days. So for me, it's not about, I have to do it because of financial restriction. I love it for the challenge. It's all about getting that really good, healthy mind frame around it too. So.
Yeah. Look, it's been an absolute blast having you here on the show, Katherine. Thanks so much for making the time to come on and chat. I've learned an absolute heap of stuff today. I'm certainly going to be going and doing a bit more research and looking at some more relevant insurance for me. And yeah, I totally would suggest anyone listening as well, do a dig, have a listen, have a look around, and potentially get in touch with an advisor to talk about this kind of stuff, because it is important. And it's something that I've glossed over quite a lot. And I think the FI community does as well, because there is that attitude of used car salesman sort of thing. So yeah, definitely encourage people to pay a little bit more attention to this. So Katherine, where can listeners get in touch with you or learn a little bit more about yourself?
There's two ways that people can do that. I've got my own podcast as well. It's called MoneyMadams with myself and my co-host Amber, who you've interviewed as well. We cover a broad range of financial topics. So that's one element, and we like to do it where possible with a little bit of a dark sense of humour. And there's links to get in touch with us on there. The other way is if you say you specifically wanted to reach out and speak to me about your personal insurances and stuff like that, I've got a Calendly page which you can find on my webpage. So that's just hcis.com.au, Hayes & Co Insurance Services, that's what it stands for. And people can book in and have a chat to me. So if they want me to review what they've got in place and have a chat to them about what they might want to consider, that's what I do.
Awesome. I'll make sure that in the show notes for the episode as well, we're going to have links to everything, so you can jump online to the blog and pretty much get in touch that way. Look, Katherine, thanks so much for making time again. It's been an absolute pleasure. Hopefully it's not too cold in the Canberra winter's night for you and you're staying warm somehow.
Yeah, I'll figure it out.
No worries. All right, I'm sure we'll be in touch in the future.
Wonderful. All right.
Okay. See you, Katherine.
All right. See ya.
Thanks for listening to another episode of the Captain Fi Financial Independence Podcast. To read the transcripts or check out the show notes, head over to www.captainfi.com for all the details. If you have a question for the captain, make sure to get in touch. You might even make it on the airwaves. You can reach me online through the Captain Fi contact form or get in touch through the socials. I'm active on Facebook and Instagram, as well as a number of online finance and investing forums. And finally, remember, The information presented on the show and the links provided for general information purposes only. They should not be taken as constituting professional financial advice. You should always do your own research when making any financial decisions and make sure it's appropriate for your personal circumstance.